In Chapter 10, we'll be discussing accounting for long-term liabilities. In this first video lecture, we're going to talk about the basics of accounting for bonds. The other topics that will be covered in this series of videos are discount and premium and amortization of those, retirements of bonds, and features of bonds and long-term notes. A bond is a form of a note payable. So we've talked about note payable before, where a company goes and borrows a lump sum from the bank, they pay interest, and then they pay the loan back. A bond is similar, except that instead of borrowing a lump sum from one lender, bonds are issued to many different investors. But it is a written promise to pay the face amount plus interest at a specified maturity date, like a note payable. Some important terminology here: the par, principal, or face value is the amount that's being borrowed. The stated or contract interest rate is the rate that is used to calculate cash payments to bondholders, and the interest payments are typically made semi-annually. So if it's a bond with an 8% interest rate semi-annually, that means that it pays out 4% every 6 months. Advantages of bond financing include that it doesn't affect owner control. The alternative being, if we issued shares of stock, then that affects who owns the company and what percentage ownership the various owners have. Interest is tax deductible, while the dividends paid on shares are not, and bond financing can increase a company's return on equity. This is known as financial leverage or trading on equity. Decreases to ROE can also result if the return earned by the invested capital is lower than the interest rate. If the invested capital does not pan out in terms of being a good investment, a company can also get in trouble because the periodic interest payments are required. So essentially, debt financing is more risky than equity financing, because if a company defaults on interest payments, it could be forced into bankruptcy. If it finances with equity, the investors might like to receive a dividend, but they can't force the company into bankruptcy if they don't get one. A bond indenture is a legal contract that sets out the terms between the issuer of the bond and the investors or bondholders. The bond indenture specifies the number of bonds issued, the par value, and the contract interest rate. Bonds are generally issued in denominations of 1,000. So a company might issue 1,000 $1,000 bonds to raise $1 million. They can be issued at par or an amount greater or less than par. We'll be talking in the next video about reasons why they might issue a bond at a price greater or less than par. But bond prices are going to be quoted as a percentage of par. So if we were going to go look up some bond prices in the Wall Street Journal, we would see numbers like 99, 101, 102 and a half, 96.5. And that means, for example, if it's $1 million worth of bonds and they're issued at 99, we would get $990,000. There is an active bond market, just like there's an active stock market. So like stocks, bonds are traded after issuance in the bond market. So our first example is of a bond that is issued at par. On January 1 of 2023, Hello Company issues 1,000 bonds with a par value of $100 at par. The bonds have a 5-year term, a 6% contract interest rate, and pay interest semi-annually on July 1 and January 1. If we are issuing 1,000 bonds at $100 each, the amount of cash we're going to collect, or the proceeds of the bond issuance, is going to be $100,000, and we're going to credit the bonds payable account for the face amount of the bond, $100,000. Note that in this case, these are semi-annual bonds. They have a 6% contract rate. That interest rate, we've talked about before how interest rates are by law expressed as annual percentage rates. So we're not going to receive or pay 6% twice a year. We're going to say our semi-annual interest payment is the face amount of $100,000 times the annual interest rate times 6 over 12, or $3,000. So we issued the bonds on January 1 of 2023. 6 months later, July 1, 2023, we're going to make our first semi-annual interest payment, debiting interest expense and crediting cash for $3,000.